India's implementation of the Goods and Services Tax, or GST, was a watershed moment. It streamlined a complex web of taxes, unifying the country into a single market. This ambitious reform demonstrated India's capacity for bold economic transformation. The GST's success has laid a strong foundation for further reforms. It has simplified business operations and boosted investor confidence. Now India must capitalize on this momentum. We need to build upon the GST's success by passing GST success to masses. These reforms will propel India towards a brighter economic future. India's complex tax system hinders economic growth. Simplifying the tax code and rationalizing rates is crucial. Lowering maximum individual and corporate tax rates to 25% can attract investment. At the same, there could be more slabs starting with 2%. This move enhances compliance and boosts revenue, as individuals and businesses will prefer to pay current tax rather than defer it. It also allows to streamline or eliminate certain exemptions, allowances and deductions, as well as broaden tax base. A simpler tax code with lower rates would encourage entrepreneurship, attract foreign investment, and ultimately lead to higher economic growth benefiting all sections of society. To further incentivize investment and boost economic activity, the government should consider exempting corporate dividends and bank interest income from taxation. This move would encourage savings and channel more capital into productive sectors of the economy. Currently, the taxation of dividends and interest income creates a disincentive for individuals to invest their savings. Exempting these sources of income from taxation would make investment more attractive, leading to a surge in capital formation. This measure would particularly benefit senior citizens who rely heavily on interest income for their livelihood. It would also encourage investment in the stock market, broadening its investor base and deepening the capital market. The Indian rupee has experienced significant volatility in recent years, frequently depreciating against major currencies like the US dollar. While some degree of fluctuation is normal, excessive volatility can create uncertainty for businesses and investors, hampering economic growth. There is a pressing need to stabilize the rupee and strengthen its value against other major currencies. This requires a multi-pronged approach, including measures to boost exports, attract foreign investment, and build up foreign exchange reserves. There is a wide gap between nominal GDP and PPP GDP. This could be due to highly devalued rupee. We need to reduce this gap to reflect true strength of India's economy. It is also essential for controlling inflation, as a weaker currency makes imports more expensive, increasing the cost of living. China's remarkable economic rise over the past few decades offers valuable lessons for India, particularly in the realm of currency management and foreign exchange reserves. China has successfully managed its currency to support its export-oriented growth model, while also accumulating vast foreign exchange reserves. India can learn from China's experience by adopting a more strategic approach to currency management. This involves allowing the rupee to find its true market value, while intervening in the foreign exchange market to minimize excessive volatility. Building up robust foreign exchange reserves is also crucial. These reserves act as a buffer during times of external economic shocks, providing stability and confidence to investors. Multi-currency accounts, empowering savings and investment. To further internationalize the Indian economy, the government should consider allowing residents to hold multi-currency accounts by depositing gold of equivalent value. This would provide individuals and businesses with greater flexibility in managing their finances and mitigate risks associated with currency fluctuations. Currently, Indian residents face restrictions on holding foreign currency accounts. Allowing multi-currency accounts would encourage savings in different currencies, reduce the demand for gold as a safe haven asset, and promote overseas investments by Indian companies. This move would align India with global best practices and enhance its integration with the global economy. It would also allow individuals and companies increase their holding of foreign assets such as equity and bring gold holding in mainstream. Capital gains tax towards a seamless investment landscape. The current capital gains tax regime in India, with its distinction between short-term and long-term capital gains, creates unnecessary complexity and acts as a deterrent to investment. To foster a more vibrant and liquid capital market, it is essential to simplify the capital gains tax structure. One way to achieve this is to abolish the distinction between short-term and long-term capital gains and harmonize the tax rates for all financial assets. This would create a level playing field for all investors and encourage greater participation in the capital market. As most of capital gain on equity gets reinvested, just like capital gain on property, financial assets can be exempt from capital gain tax. India's vast infrastructure needs require massive investments. To bridge the infrastructure gap and fuel economic growth, the government should consider establishing a sovereign wealth fund dedicated to funding critical infrastructure projects. This sovereign wealth fund could be capitalized through a variety of sources, including the proceeds from disinvestment of public sector undertakings, a portion of the government's annual budget allocation for infrastructure, and contributions from RBI, LIC, SBI, and GIC. Sovereign funds have played a significant role in the economies of Norway, Singapore, China, and Gulf countries. A dedicated sovereign wealth fund would provide a stable and long-term source of funding for infrastructure development, reducing dependence on budgetary allocations and attracting private sector participation. RBI, LIC, SBI, and GIC can play an important role in setting of sovereign wealth fund. While bold reforms are essential for transforming the Indian economy, it is equally important to maintain fiscal discipline and ensure the long-term sustainability of government finances. This involves rationalizing government expenditure, broadening the tax base, and adhering to a fiscally responsible path. A prudent fiscal policy is crucial for maintaining macroeconomic stability, controlling inflation, and creating a conducive environment for investment and growth. It also ensures that the government has the resources to invest in critical sectors like education, healthcare, and infrastructure. Although demonetization was mostly successful in future, India may go for selective demonetization of, say, 2000 rupee or 500 rupee notes while retaining other smaller denomination notes. Fixed deposits have long been a favored investment option for Indians, particularly senior citizens seeking a safe and reliable return on their savings. However, the auto-renewal of fixed deposits at lower interest rates due to multiple interest rates will erode returns for savers. Bank needs to address this issue by exploring ways to provide savers with attractive and inflation-beating returns. By allowing auto-renewal at the then highest prevailing rate of interest. Balancing the need to incentivize savings with the imperative for economic growth requires a nuanced approach. The government needs to ensure that savers, particularly senior citizens, are protected from inflation and their hard-earned savings are not eroded. With its strategic location, thriving business ecosystem, and skilled workforce, Mumbai has the potential to emerge as a leading global financial hub. However, realizing this potential requires bold reforms and a concerted effort from both the government and the private sector. The reforms outlined in this essay, including tax rationalization, currency stabilization, and the creation of a sovereign wealth fund, would go a long way in enhancing Mumbai's attractiveness as a global financial center. By creating a conducive environment for businesses, attracting foreign investment, and developing a robust financial infrastructure, Mumbai can truly become a global financial powerhouse, similar to the likes of London, New York, and Singapore.